hosted by. Welcome to my guests today, Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence, joining us from the US. Dr. Carol Knackley, CEO of Crystal Energy, joining us from Germany, and Rustin Edwards, Head of Fuel Oil Procurement at Euronav, also in Germany. So Jay Powell yesterday signaled that the US Fed will likely start tapering its monthly asset purchases as early as next month. The month after next, I'm jumping ahead, as early as November. And this week's two-day policy meeting of the Fed showed that at least half the officials see the first rate hike towards the end of 2022. Investors exhaled and US stock indexes surged. That, coupled with the EIA reporting another weekly slump in US crude stocks, propelled Brent and WTI 2.5% higher at yesterday's settle. Brent settled above $76 and is comfortably holding at those levels this morning in Asia. We might just slide into the end of this weekend with markets in a bit calmer frame, let's hope, than where they started on Monday. So no surprises, Mike, I'm going to start with you. Is yesterday's rebound in risk appetite that we saw, do you think it's temporary, or do you think we can we forget about the taper jitters essentially until the Fed's November meeting, or do you think they're going to reappear?
Well, I hope so. Typically, September is the worst month for the stock market, most notably U.S. stock market, and all assets follow, including crude oil. The problem is, I enjoyed what you had in the headlines was Gulf Intelligence, and both were more of the macro. First, the tapering, and then the stock market. And to me, that's the key thing that matters. I see the crude oil market very well balanced and near the upper end of the range, the bear market range since 2008. So we basically need the risk on to continue to resume for crude oil to go higher. Because what I've seen is divergent weakness. Crude oil peaked around 77, I'm talking WTI, in July. Stock market peaked in September. And here we are. We need to take out that high in stocks, or there's very little chance for crude oil to go higher. But what I have noticed is when we did bottom, crude oil starting to come back. So I look at it in the macro. I see WTI still very much at risk to some more risk off. And the key macro things that really scare me are this declining U.S. bond yields and the cut in the China RRR rate, which was in July, and it's probably going to continue. They might cut again because they told us what was going on when they cut that rate. So to me, it's the macro that matters. Crude oil near the upper end of the range, and you basically, bottom line, I'll say, is you need that risk on in stocks, in equities, most notably U.S., or I see most commodities, most notably the macroeconomics, crude oil and copper continuing lower, and copper did put in a pretty significant peak around $10,000 a ton, I think.
So the tapering, I suppose, was no surprise. And I noticed that Jay Powell didn't actually give a timeline, a firm timeline for the start of taper. It's more of like signal is the word agencies have used. If the Fed is signaling that it would start tapering the monthly asset purchases from as early as November. So rate hike could come potentially as soon as the end of next year. Why? Just explain. I don't look at the Fed that closely. Explain to us why the markets actually felt so much more relieved after this statement as opposed to the situation Monday to early Wednesday.
Well, that's a good question, because I think the whole concept of taper and tightening is just entertaining. The key thing the Fed's doing here is they're trying to alleviate the volatility that they created, and not really created, but really happened with the first taper in 2013. And they're focusing on it so much, it's very entertaining. To me, the bottom line is the U.S. stock market has to go higher. There's no way the Fed's going to tighten, and there's no way they're going to taper. So to me, that's what's happened. We've had the initial correction. And it's really the bottom line that matters is the stock market. So I'm going to be publishing in about 4 hours. I pointed this out, that the 20-quarter correlation between the WTI and the S&P 500 is 0.90. It's the highest ever. And we all know the issue. So to me, that's a key thing. The stock market, the Fed knows they have the most elevated stock market in history, and they have to keep it that way, or all the dominoes tumble. So they're just kind of talking us through it. And to me, that's the way we should look at it. And tapering is wonderful, But once the stock market wobbles, it's off the table.
Indeed. Carol, we had the Iraqi oil minister and Nigeria's NNPC's head yesterday say that the gas shortage unfolding in Europe and well, spreading out to other parts of the world will lead consumers to liquid fuels, causing prices of oil to surge in the winter months. We have in an item in today's News Digest that I would draw your attention to the third item there. We also had Goldman Sachs earlier renew their bullish call on oil for Q1 2022, again, giving the same rationale. Do you think these parties are simply talking their books?
Good morning, Vandana. Good morning, everyone. Well, look, I mean, this has been a very good week for oil, but not in terms of the fundamentals, but indirectly through the macro, as Mike mentioned earlier in all the news that you highlighted. So those gave a positive push to what we're seeing today in oil prices in terms of putting an upward pressure on prices. Let me add, before I answer your question, let me add to one point that Mike mentioned about the Fed's meeting and why the market more felt like a sign of a relief. We saw a sign of a relief rather than frustration. Because actually for me, I took it as the Fed telling people that we are on the right track of recovery, that both inflation targets and unemployment targets employment targets we are getting close to achieving both, because before it was mainly inflation, but unemployment lagging or not meeting a certain target. And today it seems to be sending a positive message to the market that, hold on, guys, we are on the right track. So for me, the policy of the Fed, and also taking almost 8 months for tapering and then not raising interest rate before at least a year, that is very accommodative policy. So on the macro front, we saw that in the OECD, they published their economic macro indicators, and there wasn't a major revision to the global economic growth, maybe just a small marginal 0.1%. The other big thing that we raised last week and the discussion, and that was making the market nervous, was Chinese story Evergrande, one of the biggest property a company in China and the most indebted property organization in the world, and it was on the verge of collapse, not meeting its obligations. But yesterday they also announced that they kind of reached a deal with their domestic bondholders. Now we don't know what kind of deal, no details were revealed. We don't know whether it's just a temporary thing, but that also added to reducing the pressure on the global economy and also indirectly affecting oil markets. What else is happening? So also, we saw that some draws in inventories, and then add to that the stories from Goldman Sachs and from the Iraqi and Nigerian ministers. I mean, for the last two, the Iraqi and Nigerian ministers, I don't know if it's a wishful thinking, but they do have definitely a vested interest in seeing that happening. And Goldman Sachs, they missed their 80 plus target in the summer. Maybe they pushed it to the end of the year. It might all well happen, but I'm not quite sure about this direct competition between oil and gas. So there might be some pressure there, but the gas price, the price that we are seeing in Europe, the market is currently tight, but I don't know whether it will have a spillover on oil markets. However, what I found the most interesting, and I know this doesn't really address directly what we're saying, but I found quite ironic that one of the factors that contributed to the high gas prices in Europe is the fact that, for example, China was going for more gas and less coal in Asia. But in Europe, the real switch that we're seeing because of this high prices is actually switching to coal and not really to other fuels, and to replace or to compensate for the high prices for gas. So in a nutshell, with that spillover on oil markets, I find more what's happening on the macro front at the moment have a much bigger impact on oil markets than what we're seeing with what's happening with the gas crisis.
Absolutely. And exactly as Mike says, that's one very good reason the oil market participants will have to keep a very close eye on not just the Fed, but what central banks in Europe are doing or elsewhere in the world, what inflation is doing, what macroeconomic data. I mean, you can't just be an oil market expert anymore. You have to understand these big micro-financial moves as well. Rustin, from your perch, I think you would be an excellent person to tell us a little more about how you see this gas shortage spilling over into oil, or more specifically fuel oil. Do you really see that coming your way?
Oh, it's already hit. The utility switching's already been done. As the price of BTUs go up, you have to find the least cost BTU to come into your unit in order to meet your electricity needs. Now, a lot of electricity grids are price controlled by their governments, and so they need to find the cheapest fuel source in order to meet those electricity demands. Otherwise, their pricing goes out of whack. Now, the UK, a bit of a different animal because you have an unregulated market. So the price of electricity is the price of electricity. And has been reported here in the last couple of days, the high nat gas prices are causing electricity providers to go bankrupt. They can't afford to supply the electricity to their customers because the price of the energy is a lot higher than what they sold it at. But net, the whole nat gas crisis is an issue that stems all the way back to the massive shutdown in shale production back in 2020. When U.S. crude dropped from 14 million a day down to 10 million a day, you lost a lot of associated natural gas, which was basically exported out to Asia and to other markets to fill up storage caverns. And so we saw the first rearing of all this back in the winter of this year when Asia nat gas stocks dropped so dramatically on the cold winter, they started buying up low sulfur fuel content to come back into the utility space. And they haven't been able to refill those stocks. So if you look at the injection rates of natural gas around the different areas that burn nat gas in the utility space, they're at a fairly low level going into another winter. So now you've got a massive weather event that could again cause a big spike in prices on the utility front, which will then pull other utility fuels in. If you look at the prices of high sulfur fuel and VLSFO east of Suez, I mean, there's a massive backwardation right now in the high sulfur fuel market. High sulfur cracks are starting to move higher. Part of that is also being stemmed from the fact that the Marj field is down and probably won't resume production until February of next year. That takes 200,000 to 250,000 barrels of high sulfur crude off the market, which makes high sulfur fuel oil. You had the Syncrude outage that you mentioned in the headlines today. That's another 20% of high sulfur fuel production that's away from the market. So it starts creating this tightness in the high sulfur fuel space, which is used primarily in a lot of utility spaces. So now you've got this competition of price per BTU per electric spark spread that is now starting to get squeezed on both sides. But eventually what should happen is that as companies switch from nat gas into fuel oil, nat gas should start to come back in and start refilling back into the void because there's no demand for the nat gas. But it's probably not going to happen as quickly as it can happen, and we'll probably see a very big squeeze going into the winter. I'm quite bullish on the fuel oil side of the barrel and also on the distillate side of the barrel for that matter. Okay, so for the next 3 months or 6 months? Well, Q1, Q1 as we go into the winter. Okay, so presumably going to pinch the bottom lines as well of shipping companies? It hits everything. I mean, so the earnings on the shippings get squeezed because the price of fuel goes up. The transitory inflation, well, that just keeps transiting down the curve as more and more people have higher cost of goods. Cost of refining goes up because they're going to be backing out nat gas and burning their own fuel, which means the price of carbon emissions start to go up in certain markets because they're burning higher carbon material because they have to, otherwise they shut down. So it causes a massive inflationary push going into Q4, Q1. Yeah, indeed. Some days I sit and think, is there anything that will relieve the inflationary pressures and supply chain bottlenecks? OPEC's got their 5 million barrels sitting on the sideline. They can open up those taps and that will put a lot of pressure off the market. Yeah. Mike, some people might hope that a stronger dollar, at least perhaps, brings some relief to commodity prices and in having an inverse correlationship with most commodity prices and definitely oil as well. The US dollar has been hovering around 1 month highs, I noticed. The dollar index is well above the 93 handle. Where do you see the greenback over the next, let's say, 3 months? Or if you want to talk about a longer time frame as well.
Big picture, greenback only goes up. And I only say that because it's the fact. Depends on how you measure it. So when people talk about the dollar, I like to use the Federal Reserve Trade Weighted Broad Dollar Index. Okay. For the last 10 years, that's up about 30%. For the last 50 years, it's up about 300%. What are you measuring the dollar against? Other fiat currencies. And people get so bearish the dollar. I always like to say, okay, well, who has higher relative yields, stronger stock market, and provides defense for the world? And that's just the way the dollar works. So when people, I like to see how you measure the dollar. Now, if you measure it versus gold, I'm fully expect the dollar to depreciate. If you measure it versus Bitcoin, the dollar is going to depreciate. But versus other currencies, and what's happening to me with the dollar is it's all good for commodities, but all currencies are going down together. And I like to use what that Churchill said about democracy. It's the least worst government except for all the others. And to me, that's the way the dollar is. And the facts are there. So it's bottomed from a good level. It's had a backup within a more enduring trend. It should continue to rally versus other fiat currencies. So to me, that's the key thing to distinguish with the dollar. And I just do enjoy that narrative when people get bearish the dollar after it corrects. I'm like, has not worked for 50 years, depending on where you go on the scale. So I'm very bullish the dollar only because give me a better currency that's going to last. It's going to appreciate versus a dollar in the next 2, 3, 5 years, and there's only few, and they're minor. Maybe the Swissy, but you don't have the yields, and you don't have the strong stock market and the oomph behind it. It's just the fact of the reserve currency. And I'll leave you with this: the key thing I've been really impressed with the dollar lately is what's happening with crypto assets, crypto dollars. Something a lot of people don't know about. It's something we all need to know about, and that is the most widely traded asset in this crypto area is not Bitcoin and Ethereum, it's digital dollars, crypto dollars. More than double or triple the volume of all these other cryptocurrencies. The reason I mention it, it's not because of the fact that it's happening, because it's free market capitalism in the world, and they've completely gravitated towards the dollar. 95% of all trading is in dollar based in that infrastructure. And it's just an example where the world's going digitally. It wants the dollar, it doesn't want the yen or the euro.
Yeah, and for those of our participants today who want to delve a little bit deeper into what Mike is talking about, we have Mike's piece. It closed in today's reading list, so do take a look there. Carol, the current view in the market, so as Rusted was mentioning, OPEC Plus is still keeping give or take 5 million barrels per day out of the market. The current view in the market appears to be that OPEC Plus will stick to its current tapering plan, at least through the year end. We heard the UAE minister confirm that pretty much earlier this week as well. Do you see any circumstances under which the next ministerial meeting, I believe it's on the 4th of October, may end up springing a surprise on us?
You should always expect the unexpected with OPEC Plus, right? As experience has showed us. So really, and actually, and they make a point out of that. So yes, they do have a plan to appease market fears, for instance, and also to help with their budgetary planning as well. But at the same time, they come with a kind of disclaimer that it all depends on developments in the market. So it's not that their plan is cast in stone. They will revisit their plan if market fundamentals change drastically to justify a reversal or maybe a change in their decision. And the moment I don't see that happening. So I don't see market fundamentals changing drastically to cause a change in OPEC Plus policy. But who knows what happens between now and October? I mean, look at us. We meet on a weekly basis, and every week sometimes we discuss the apps, prices rallying up, and the next week we say prices went down because of all sorts of surprises. But let me go back on a point that you make, a very good point about relieving inflationary pressure. And there was an interesting interview, if I'm not mistaken, with the chief economist of the OECD, or an official from the OECD, and he made a very, very important point about the role of central banks and governments when it comes to tapering their policies and removing the fiscal stimulus and the monetary support to the economy. And that particularly for central banks, that they should be more transparent, because you have an article on transparency for all companies, we'll come back to that, but also central banks have to be very transparent and communicate clearly to the market what they want to do next, particularly the fact that inflation is more a transitory and not a permanent problem. Because if you don't do that, then businesses might fear that, okay, that's it, we're going to push prices up because costs are high. They may not really believe that it's just a temporary supply chain problem. Consumers, or probably actually workers, would demand higher wages, and as a result you risk transforming a problem which is temporary to something more structural and more permanent. So this is where communication is very important on behalf of central banks. And one more point which I would like to add, and which you haven't alluded to this morning, that we seem to overlook the issue of vaccination. because still, when you look at growth rates around the world, GDP growth rates, they mask a continuous uneven growth. So yes, you're asking about what's going to happen in October, but there are more fundamental problem that is uneven economic growth continue to develop around the world. And unless you get vaccination rollout rate more even around the world, you still have big question marks hanging on the growth of the economies around the world, particularly in the emerging and developing economies, and that will cast a greater shadow on oil markets as of next year.
I would agree. And I can, from that perspective, I can almost understand OPEC's caution, not just now, but right from the start of this year, that, let's be careful. I do find a little bit of a divergence between OPEC's caution when it says, let's be cautious and conservative in putting more oil into the market. But when you look at OPEC's monthly reports and their forecasts for demand growth, and especially if you compare it with what the IEA is saying or the EIA is projecting, OPEC seems to be the most bullish. So there's a bit of divergence there, but I guess one can understand there needs to be cautious in how they bring the oil back onto the market. Rustin, one of the items in our reading list today is from yesterday's development. Top global companies call for zero emissions shipping by 2050. Now, mind you, that's zero emissions, not net zero emissions. Would you unpack for us first of all the big difference so that people understand clearly there's a big difference between the two phrases? And the second part of my question for you would be, do you see such targets leading the shipping sector into more stormy seas?
Well, I mean, zero emissions, as the name implies, means you're not emitting anything that's harmful to the atmosphere.
At all.
I don't think you can ever have a zero emissions because, we all live and breathe and we're all emitting bad gases every time we talk, every time we breathe. So it's not like you can get to actual zero, but getting rid of the more dangerous emissions like NOx, SOx, CO2, methane, whatever that comes off a ship as it operates around the world. The net zero is more of how you balance your emissions and get to a zero on a balance sheet per se, if you want to look at it that way.
You offset some
where
of
you
your
use offsets to counteract your emissions, which is I don't want to say paper overing a hole in the wall, but that's probably my best analogy. Currently today, that you use paper to cover up what your emissions are because you're buying carbon credits from some projects down the road. But nevertheless, it is something that, when you think of where the world is today and where the world needs to go in the next 30 years, there's a lot of technology that has to be developed in order to get there. And so it does create a very interesting dynamic within the shipping industry because you have people trying to pick a winning horse before you start the horse race, because the infrastructure around delivering fuel to a ship has to be developed in order to meet the fuel demand of the vessel, which also needs to have an engine designed and a handling system on the ship in order to handle the fuel on the ship. And so a lot of the future fuels that people are talking about, everything from biodiesel, LNG, LPG, ammonia, hydrogen, methane, methanol, there we go. They all require their own special handling characteristics and their own infrastructure that has to be built. And as of right now, the world is still sitting on a bunch of oil tanks and a bunch of oil barges to move oil onto ships. And to transform that whole entire infrastructure over the next 30 years, massive investment opportunity, but it's also going to cause a lot of false starts. Like for instance, right now, if you take a look at natural gas prices today and you're making an investment decision, do I want to build a ship that's going to run off natural gas? Well, if you don't have that price contracted out, you're probably not going to make that investment because on a BTU per horsepower basis, you're buying a much more expensive fuel than biodiesel. So there's a lot of decisions that have to be made, and it is going to cause the shipping industry to have to coalesce around a pathway to get from where we're at today to zero emissions in the future. And that's, I think, where the biggest opportunity sits within maritime, is that if the different arms of the industry can come together and coalesce around, this is how we're going to do it. We're going to go X, Y, Z. And then once X, Y, Z is known, then investments can be made in X, Y, Z to actually develop the technology, develop the infrastructure, and then it becomes a seamless transition. If that's not done, and we continue down this haphazard approach of everybody's kind of going their own way, trying to feel out which direction they need to go, then you end up with potential pitfalls that could cause spikes here, crashes there, and you don't have a streamlined transition into the future. You've got a very nasty experience. Yes,
indeed. So the devil is in the details here, right? IMO 2020 got pushed through, one would think reasonably successfully, but this 2050 is, to me, at least it sounds like a bit like a pie in the sky.
It's the moonshot. It is the moonshot. I mean, because if you think about it, it's going to require that much thought, that much investment around making that happen. I mean, we're talking trillions of dollars that has to be put into R&D, and then another couple of trillion to actually build and develop. So if the world can't get their heads around it, and governments can't get their heads around it, and you can't get the right supports in there to make it work, it's going to be a very hard road to move forward.
Yeah. Talking of hard roads and how do we move forward, let's have a survey question today. So after Powell's speech and the IEA's US stocks report, showing a big plunge in especially in crude stocks, Brent leapt up to a 2.5% higher settle yesterday, $76.19. It was close to 2-month highs. Where do you see prices in the coming week? Range bound around current levels, or continuing to climb towards $80 a barrel, or retreating towards the low $70s? Welcome your thoughts on this. And I'll go back to you, Mike. So we've had the Fed meeting done and dusted. We have you've already told us your views on, you think that you're bullish US dollar. There's the US government debt ceiling drama hanging over our heads, and that might continue to rattle markets going into the next week. How would you suggest oil market participants look at the macroeconomic picture going into next week?
Yeah, I have a hard time with figuring out 1 week at a time. 1 year is kind of what my bigger picture thing is, and I think the key thing for next week is really going to be what's the debt ceiling is usually just a bunch of bogus discourse. It's just come on, let's get this over with. So to me, it's really about the macroeconomic, and to me, the most powerful force on the planet is when the stock market, U.S. stock market, declines. If that's off the scene, like it kicked in last 2 weeks ago, if that doesn't matter, then crude oil will stabilize, and we should be stuck in this range. And maybe it gets near 80, maybe it gets near 60 or 70 on the lower end. It just knocks around. The stock market has to go up. To me, that's the bottom line. Otherwise, it's more trees in the forest. We're just trees in the forest trying to analyze supply and demand, which overall, the big picture is just not good for crude oil. I mean, why is it half the price it was in 2008? It's the macro that matters. As long as the U.S. stock market is stable, then crude oil will remain in the range. And to me, the bigger risk is that we just see a little bit more, way overdue mean reversion in the U.S. stock market, which means the whole tide goes lower. But for now, we're stable. And the bottom line is that's really what matters, is that most powerful force that started kicking in needs to not be there. We need this U.S. stock market not to wobble, just to kind of not go down.
And what is your gut feel? Do you think it will wobble some more, go down or up, or steady next week?
I'm sensing a liquidation. I'm getting this from the major money managers I see, and I have a big weakness for following interest rates. Cut in the Chinese RR, declining U.S. bond yields, strengthening dollar. Those are not good for crude oil. Upper end of the range, copper's peaked, lumber's peaked, corn's peaked, soybeans peaked. I'm bearish commodities.
Okay, let's have the survey results, and we'll give Carol the last word. Oh, wow. Evenly split between range bound around current levels and continuing to climb towards $80. A minority are bears in this room today, thinking that it will retreat towards the 70s. That's interesting. Carol, the several 100,000 barrels per day shortfall in OPEC plus production in August vis-a-vis its target seems to have accentuated worries that most members of the alliance have lost the capacity, temporarily, perhaps even permanently, to ratchet up output in line with quotas. Do you think this is a issue to worry about? Perhaps not so much in the next few months, but especially in 2022. Especially if demand continues to ramp up as it is currently expected to.
Yeah, you see, I'm not that worried about it because I concentrate on the big players, and those who are struggling to expand their capacity. It's not, they are not facing this problem only today. This is a structural long-term problem. So they have failed to attract necessary investment. Their NOCs are not maybe as wealthy as what you find in the Gulf countries, such as the Aramcos and ADNOCs of this world, to carry on all these big commitments. And they did not undertake the necessary reform to bring in the capital. So it's not something new, and it did not emerge only today. And whereas when you look at the big boys in OPEC Plus, they seem to be, we shouldn't really be worried about it, because while the whole world was moving away from investing in oil and gas, they were pumping hundreds of millions and billions of dollars actually in the oil and gas.
And still are.
And still are, and they have no, I don't think they are looking back on their decision. But I would like to add an interesting point that the Nigerian oil minister, I think it was mentioned in one of your news items today, calling for adding their production capacity or quota within OPEC Plus. And that is not something that happened today. If you remember a few months ago when there was a spat between Saudi Arabia and the UAE, because the UAE asked for a higher production quota. And this, although a deal was reached then where I think 4 countries were allowed to kind of increase their production quota, but other members are going to follow suit, even though their production capacity expansion may not be possible. And that is for me a more interesting dynamic on whether they will be able to deliver or not.
Okay. Great. With those insights, we will close today's session. Thank you so much, Mike, Rustin, and Carol. Have a great day and weekend ahead. Bye-bye.
Thank you. Bye-bye.